The following podcast was recorded on Tuesday, June 28th, 2022, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to the latest edition of Talking Data. I'm your host, Kristen Radosh with Arbor Research and Trading, joined today by our presenter, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will give us an update on valuations and the financial sector. Jim, is the stock market cheap?
By some measures, it is cheap, but that might be deceiving. So let's run through it here real quick with the first chart. First chart, the black line shows you the S&P. It has been declining all year long. As a matter of fact, we're going to finish off, assuming nothing happens between now and Thursday, the worst first half of a year in 52 years. You got to go back to 1970 to find a market that was worse than this one that we've seen so far. The blue line is the interesting one. That is the 12-month forward earnings estimate. Now, this is calculated by taking every Wall Street earnings estimate on the street and then aggregating them for the 500 companies and doing a median estimate of that. It is higher now than it was at the beginning of the year. So as the market has been falling and has talk of a recession or at least a severe slowdown and aggressive Fed hikes have been increasing, Wall Street analysts have been upping their earnings forecast. So if you go with the combination of falling stock prices and rising earnings, you get the next chart, which is arguably Wall Street's favorite metric, the 12-month forward PE ratio. So this is price divided by the earnings estimates over the next 12 months. And that PE ratio has fallen down to under 17. And if you look closely, that's about the lowest level we've seen in 7 years. It's very close to the lows that we saw during the pandemic bottom in 2020, and it's way off the highs of 27 back in late 2020. So a lot of people are saying, well, the fall in the market and earnings estimates holding up means that the market shows that it's gotten a lot cheaper. Mechanically, that is true. But can we trust those earnings estimates? So the next two charts will show that. The next chart shows this is the global earnings revision index by Citigroup. Now, what they do is they look at all earnings estimates globally. And the US is pretty much the same thing, but I prefer using the global one. And they take just the number of analysts that are upping their earnings estimates minus the number of analysts that are downing their earnings estimates. And we've got negative bars, meaning that every week more analysts are cutting their earnings estimates than raising them. So we're starting to see, as the chart shows, in the last 3 or 4 months, some earnings revisions showing up negatively. Now, if we go to the final chart, at least in this section, this shows the 1-year earnings error rate. Now, the way I calculate this is we take the forward earnings estimate, the blue line, that's what Wall Street thinks is going to be the earnings estimates in a year, and we shift it backwards a year. And then we take the orange line, which is trailing earnings, so we could then plot the difference between the two in the bottom panel. So what the bottom panel shows you is what was Wall Street's earnings estimate 1 year ago, and what are the actual earnings now, and how accurate were they? Notice the shaded areas are recessions, and notice what happens to earnings estimates going into and coming out of a recession. The error rate goes severely negative. To restate that, Wall Street grossly overestimates earnings when there is an economic slowdown into a recession by as much as 40%. So is the market cheap? Yes. If you believe the earnings estimates are not about to get whacked 40% like they have in every other recession, assuming that at a minimum we've got a serious slowdown. I've argued, like we did on our conference call last week, I think the recession has already begun. So if that's the case, maybe the market is not cheap. It's just an illusion because Wall Street has been very slow in bringing down their earnings forecasts. And when they start to bring down their earnings forecasts, valuations are going to worsen. They're not going to get better.
What is the message from financials?
Yeah, so shifting to financials, if we go to the next chart, they have been, and I'm going to use a technical term here, they've been a killing field. The fastest way to wreck your career is to basically be in financials for the last 15 years. So right now, the chart we'll start with, just to illustrate the killing field, is the orange line is the change of Bitcoin's price, cryptocurrencies, which is supposed to be the new financial system. Count me among those that think DeFi has that capability. It's down 26% since the end of 2020. FinTech, the Blue Star FinTech Index, is down nearly 40% and has underperformed Bitcoin over the same period of time. So FinTech, financial technology companies, are supposed to revolutionize the financial system using the current payment rails. Cryptocurrencies are supposed to revolutionize the financial system using new payment rails. They're both getting crushed. Now, if we go to the next chart's a bit of a messy chart. It has all 11, it starts February 20th, 2007, and it shows all 11 S&P sectors plus the banking sector. And the thick black line, I know that's kind of grayed in the background a little bit, is the overall S&P, but I highlighted the financials and the banks. So since the peak before the financial crisis 15 and a half years ago, the financial sector of the 11 sectors of the S&P, the orange line, is last. It's been the worst performing sector of all the 11. Within the financials, the largest sector, with the largest industry within the financial sector, are banks. They're up only 16% in 15 and a half years. They give you about 1% a year. They're worse than the financials. So what is the single worst idea you could have had over the last 15 years? It's been the financial sector, and particularly the banks, and that's continuing this year. Since January, the bank index is down 30%. In order to restate it and broaden it out, is the next chart. The next chart shows you the blue line is the bank stock index, which I showed you before. The red line is the Japanese bank stock index, and the green line is the European bank stock index. Yes, in 15 years, they're down 60 and 80% in 15 years, the banks of Japan and Europe. And the black line is the 3-month bill, which spent most of the last 15 years yielding zero, which is why it's a horizontal line. Yet collectively, you would have been better off in a zero yielding bill than you would have been investing in the banks over the last couple of years. So the message here is, whether you're talking crypto, fintech, financials, banks, whether you want to add in Japanese banks, European banks, the financial sector has been an absolute disaster to invest in. The takeaway from all of this is, I think that in the 21st century digital economy, the financial sector is not meeting the needs for it. That is why we've had these flirtations with fintech, and why we've had these flirtations and continue to have these flirtations with cryptocurrencies. Disruption is ready. Disruption is right. Something has to change. The financial sector itself, the 15 years of poor performance, is the market saying, I'm sorry, JP Morgan, Citibank, Barclays, Deutsche Bank, on down the line, you're not going to do it. Or they don't have belief that you will remake yourself into what the 21st century needs. The flirtations with fintech and with cryptos was maybe they would do it, but now they're on the downside. Now, part of that, especially when it comes to crypto, might be regulations. The banking regulators, being the central banks highlighted by the Fed, the FDIC in the United States, the European Banking Authority in Europe, on down the line, they're really not ready for this kind of change. But we're at a difficult place. The economy needs a new financial system. It needs faster payments. It needs individual payments. And, you know, as I like to say, there's really no reason for us to ever really pay a monthly subscription fee for anything. To take Netflix, you should just be able to connect to Netflix, and they should charge you, pick a number, 5 cents a minute. And if you spend an hour on Netflix, you know, they charge you $2, as opposed to paying a monthly fee. And you can jump to any service you want, and every minute they take a nickel from you. Financial system can't handle that right now. The payment rails are way too slow. It's way too expensive. Remittances are too expensive as well. And I think what the market is saying is, this has to change for a 21st century economy, and we're still looking for a place to change it. The problem with why we can't change it is that we've got way too many entrenched interests, and we've got regulators whose job it is to make sure that regulators still are employed. And so that's why we haven't had this change. So to sum all of these up, the market might look cheap, but that is based on earnings. And one of the things I think that's holding back the economy and holding back the market is one of the larger sectors should be financials. But I think that they're basically waiting for somebody to do to financials what's happened to newspapers, what's happened to retailers, what's happened to a lot of other industries because of digital technologies, the internet and the like, that there's been enormous disruption along the way. Financials are the next one in line, I think, that need to see that happen. After them, it'll be healthcare. That'll take a little bit more doing. But that the market is showing widespread disappointment because fintech, cryptos, and financials are all struggling. And if they continue to struggle and earnings come down, that overvalued market might not look so overvalued as we move forward from here.
Well, Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, please contact Gus Handler at gus.handler@arborresearch.com. Thanks everyone, and have a great day.